This is Alan Bush with ADMIS. In the stock index futures, we are seeing prices higher this morning. Much of this strength linked to better than expected corporate earnings. Also, we had no new expanded geopolitical problems, so all of that supportive to futures. Also, we have taken out some very steep downtrend lines on the upside today in the S&P and in the Dow, so a much better technical viewpoint now compared to what we had seen last week. Longer term, we still feel that the world's major central banks are going to add more stimulus, and that bullish influence is likely in the long run to dominate over the geopolitical problems that we have currently. Over in the currencies, seeing the euro currency under quite a bit of pressure as the European Central Bank continues to buy bonds in their asset purchase plan. The reason for weakness in the euro is that these asset purchases drive down interest rates in the eurozone, and of course that's bearish the euro. Also seeing some strength in the Australian dollar. This after China's GDP coming in better than expected, up 7.3%. The guess was up 7.2%. And of course, China and Australia are very good trading partners, so the fortunes of China often reflect back on what is happening in Australia. Still feel, though, that longer term, as interest rate differentials no longer are widening and are likely to converge to some degree, that breakouts in all of the currencies will probably fail in both directions. And I think that is a trend that will probably persist through this year. However, in the interest rate markets, if we are right in our thinking that a new wave of global central bank combination is on its way, that is all the more bullish for the interest rate futures markets. However, we do have the Fed meeting at the end of this month, and it is likely that the central bank will end their asset purchase program at that meeting. However, there is more and more talk that at some point down the road, the Fed may need to add more stimulus in one form or another. So we feel that with the global economy slowing, that the need for more stimulus here in the U.S. from the Fed, and at least that is what we're hearing from quite a few Fed officials, that the main trend is still higher in treasuries, thinking if we do break another point, possibly a point and a half in the 30-year bonds, I think that would be an area of value, and I would come in on the buy side in the 30-year bonds. Longer term, the main trend is higher for treasuries, especially for the long end. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.